Welcome back to That Investing channel, where I invest in a concentrated portfolio of individual holdings that's valued at over £59,000 in my Trading 212 Stocks and Shares ISA. Today I'll be sharing a brand new position with you guys that is currently down 28% in the past 6 months and sitting at a 52-week low that I have purchased for over £2,000. I'll be going through the most recent earnings, financials, and my valuation and fair value on this position using Stock Unlock. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So let's talk about the company I've put around £2,000 in, which is quite a substantial amount of money for me. This is a holding that I've actually owned in the past and made a fairly good return on. I made about 20% return when I sold out of this position before, when it was quite a bit up from where it is now. And now with its cost basis well below when I bought it originally, I'm starting to think that this huge sell-off it's seen after its earnings report is massively overblown and it is presenting good value right now. It's actually more of a defensive name that's quite recession resistant, which I think is quite appealing in this environment, and offers a big free cash flow yield currently, in a time when there's lots of uncertainty around tariffs and how growth companies themselves will maybe necessarily perform in this landscape. And that sort of appeals to me when I've got a lot of my portfolio held within growth stocks. And that company is UnitedHealth Group, and this is a position that I've just recently started that I think offers really good risk to reward, especially in this uncertain environment, because it is such a steadfast, shareholder appreciative and recession resistant company. So here we have UnitedHealth Group. I've got about 6.45 shares. It makes up around about 3.3% of the overall portfolio right now. And you can see that the price action has been quite extreme for this business, all quite recently actually. It's now dropped well below my cost basis of around about $418 per share. It's now sitting below $400 per share. And I think it still is considerably undervalued based on its financials. If we just take a look at how it's performed the past 3 months, it's down over 26%. And people are just pricing in as this company is going to go to zero. There's no real hope because the share price has done so badly. And the way I see it is that this business that was just trading at $592 on Thursday, the 17th of April, is still an amazing business at $400 or less. And the reason for that is because of what it presents in terms of its financials and opportunity. It's a business that is still growing very rapidly, above 10%, that is gigantic, that's dominant market position in its chosen area of expertise, which is obviously Medicare and specifically American insurance medical care. And I think this one is just set up to do very well for the future because the financials don't lie. And if they're telling a story as this one is, they haven't had a down year in revenue or increases in revenue that hasn't been expected since around 2012. So it hasn't missed or increased its revenue since then. And if we think about how hard that is to do, it's actually very difficult to do, and not many businesses can do it. And this is just one of the good things that I like about United Healthcare. Now, they had very bad earnings, and there's no shying away from that. So obviously, it says here that shares of UnitedHealth Group dropped around 20% from Thursday after they had an unexpected, weaker than expected Q1 2025 results, and they cut their full year guidance. So as it says, their earnings, specifically their adjusted earnings, was expected to be $26 to $26.50 per share, which is what they've now revised it to be. And they was expecting around about $29.50. So they've downgraded it considerably. It's quite a big jump down in EPS. And there is obviously a reason for that. They had a lot better consensus guide on from analysts. And I think that the main reason that they've said this is the case is because of medical care costs and weaker than expected anticipated performance for one of their subsidiaries, which is Optimum. And I think this main thing is something that is maybe going to be short-lived over maybe next year or 2 years, but it's something the company is going to get over. So the company cited a surprising uptick in medical usage within its medical advantage business, particularly for outpatient and physician services. And what I quite like about this is that even though this Medicare cost ratio has now increased to 84%, which missed expectations, this is something that is considerably concerning for this business, but something that they say they can actually sort out. And the reason they've said that is because they're going to address it looking forward towards 2026. And this is part of the reason I got out of this business before. And now I'm actually starting to think that this offers such a good opportunity, because this business is trading for such low earnings that it's expected to just crash and burn. It's priced and its fundamentals are like it's a business that is dying out, that's not growing at all. And we're seeing revenue growth that's well over 10%. So when I'm seeing something like this from a highly profitable business with good margins that's proved that it can execute very well with a world-class management team, I don't really see the same thing as what other people do. I don't see a dying business here. I see a business that's going to do very well over the longer term, but is suffering from short-term headwinds in the form of Medicare expense ratios. The share price only really tells one story. The other side of the story is that we have a price to earnings of around 16 times for UnitedHealth Group, which is exceptionally low for such a high quality business. And then we've got the likes of price to free cash flow, which sits around 14 times. And its revenue growth over the past 3 years has sat about 11%. So it's not dying. It's not flat on its earnings growth or flat on its financials. It's actually rewarding shareholders for owning the stock by buying back shares. So when I look at this sort of business and see this sort of price to earnings and price to free cash flow, I wonder what other people are seeing. And it's because they're concerned about the likes of the Medicare costs and everything else. But I just don't see that as being a substantial long-term headwind for this business. And I think it's something management will be able to sort into 2026, 2027. But it's a business that essentially is rewarding shareholders at all times. Earnings per share growth has steadily increased. And in 2024, yes, it was down, but they had a one-time expense in the form of its it had a cyber attack that caused massive damage. They had to repay all that. So this would have actually sat closer to about level with 2023 if they had not had that cyber attack. So that was a one-time event in my mind. And what we're seeing here is people are looking at this and maybe thinking, well, this is dying now because of this. But this was a one-time event. Then we've got operating cash from operation activities as well, and that has steadily increased, again affected by this one-time event in 2024. So I'm not seeing the same thing that maybe other people are with this business. And just to follow on the valuation side of things, at the moment we're seeing around about a 16 times price to earnings for this business. It's not really showing it, but the latest is essentially around 16.47. And historically, that's been a very good time to buy this business. UnitedHealth Group is a business that normally trades around about 22 times price to earnings over the past, say, 10 years. And we can say that, yes, but they didn't have these Medicare expenses, costs adds on, but the company is still growing rapidly in forms of its revenue, over 10%. It's growing its EPS numbers. And it's growing in every meaningful way that matters, and it's rewarding shareholders in the form of a growing dividend and the likes of share repurchases. So to me, this is a business that is shareholder focused, but shareholders are actually selling out of the position before it's even had a chance to maybe recover from this event. Now, this isn't a company that's necessarily going to grow this price to earnings very well this year. I don't think they're expecting massive amounts of growth this year. I think it's around about minus 3%. But looking forward, because we're long-term investors, looking towards 2026, 2027, 2028, earnings per share and price to earnings look like they will go up by around about, say, 10%, if not 15% or more. And when I see it trading for around about a 16 times price to earnings and the earnings themselves are expected to grow at around about 15 to 13% over the next, say, 3 to 5 years. I just see that as a massive win. It's a PEG ratio of 1. It's a company that is expected to be dying, but the financials are not backing it up. From looking up UnitedHealth Group's earnings per share, which is the main metric that I want to use to value this company, they're set to grow it by around about 15% from 2026, around 14% in 2027, and around 16% in 2028, before maybe stepping down to around about 11% in 2029. So that's our sort of time horizon, about 5 years, and a growth rate that is well below that at around about 12%. And then we have shares repurchases, which is obviously something that they do automatically anyway. And we have a dividend growth rate that is sat on the 5-year average around about 14%, which is great for dividend growth-based customers. And then we have their price ratio, price to earnings, the likely outcome. And I think once UnitedHealth Group's demonstrated that it is shareholder focused, recession resistant, and gets through this period of Medicare expenses coming back down to more appropriate ranges, they may trade for a price ratio of 21. And if all of this happens, if this is how things go, then we could be looking at a fair value of $619 per share and a 20% CAGR over the next 5 years, with a share price that currently sits around below $400. So I see a lot of value in this one. I see a lot of upside potential with not a lot of downside risk because of the certain things that they offer to shareholders, and I just think people aren't really factoring that in. I mean, it's a free cash flow yield at the moment of around 6% when it's a business that's growing revenues above 10%. So I don't see this dying off business. I see, yes, expenses ratios going up, and that's concerning. But I see it as something the management can get a handle on in the years to come. This will not be a great year for this company, but I do think that 2026, 2027 and onwards, this one will recover, do very well, and shareholders will reward that with a share price increase massively. So I think this one has a lot of upside potential, even if we're allowing for a lot less of a growth rate. And even if we allow, say, for what they predict, around 14% in analysts' expectations, and say they trade for their past 5-year average of 24, then we still get a massive CAGR for this business, over 25% return. So whilst I don't think that factors in enough margin of safety for me, I do think that there is a lot of upside with this business, and it is one to consider, especially for dividend growth investors. But that's just my take on it. What do you guys think? And as always, thanks for watching. I appreciate it, and I'll catch you in the next one.